like the bond market would revolt. So that tells you, but that gives you some sense of you're going to need at least 15% inflation for at least 3 to 4 years. And every day they delay puts a little bit more upward pressure on either the rate of inflation or the duration of the inflation. In other words, you need higher for longer inflation.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a fascinating discussion lined up today that I'm incredibly excited about. Today, we are fortunate to have with us Luke Groman. Luke has become one of the most respected names in the global research sector. He's been in the industry for 20 plus years. He's earned a reputation as a client-focused analyst with an unparalleled ability to make broad connections between increasingly siloed industry news and drawing conclusions that help investors understand the bigger picture. He's the founder of FFTT, which caters to institutions and sophisticated individuals by aggregating a wide variety of macroeconomic, thematic, and sector trends in a very unconventional manner to identify investable, developing economic bottlenecks for his clients. Luke is a highly sought-after speaker, a thought leader, and we're so pleased to have him here. Luke, thank you so much for joining us today.
Thanks for having me on, Gary. Thanks for the kind introduction. I'm looking forward to our conversation.
Fantastic. All right, let's begin our discussion with the current fiscal dominance that the U.S. is in. The fiscal dominance seems to be crowding out growth, which is leading to stagflation. In the first quarter, the U.S. economy grew at a 1.6% annual pace, falling significantly short of estimates, while at the same time inflation is increasing. Will you speak into this economic picture for us?
I think ultimately what we're seeing is strong nominal growth and okay real growth, really inflation driven. The degree of fiscal dominance in sort of the purest sense of the term is dependent on the level of the dollar on some level, the level of inflation. Ultimately, what I'm watching is the Fed rate hikes have driven higher interest expense on a lag, given that we have $35 trillion in debt. These are the highest or the fastest Fed rate hikes in 40 some years, which everybody knows. But not a lot of people, when they say that, say it's also the fastest, I think, ever with debt to GDP at 120% with 35. No one, we've never been here before. This is like through the looking glass. And so the implication of this is pretty straightforward, which is interest expense goes up a lot as a percent of GDP. Functionally, there's very little difference between the government paying interest to investors or to citizens, or the government paying COVID stimmies to citizens. The only difference is that it's a little bit more of a lag. It's a little more regressive. In other words, wealthy investors tend to get more of the stimmy as opposed to everybody. But ultimately, those wealthy investors tend to be people that eventually spend it, especially boomers that they're not going to live forever. They know that, especially after the last 5 years. And so they're spending all their money fast. And so as they're getting these stimmies, they're using them in restaurants, cars, helping their kids buy houses, vacations, etc. And so it's a little delayed versus just sort of the straight heroin to the jugular stimmy that was COVID, the COVID stimmies. But functionally, there's no difference. Once you adjust for that lag, there's no functional difference between $1 trillion in stimmy and $1 trillion more in interest expense. It's the same. $1 is $1 is $1. So unless, as interest expense goes up due to the Fed rate hikes, the fiscal authorities, the U.S. government comes out and says, you know what, we're going to pull back from Ukraine. We're going to pull back from Israel. We're going to pull back from Taiwan. We're going to bring home about two-thirds of our overseas bases. We're going to cut U.S. entitlement spending immediately, permanently by about a third. And of course, none of those things are happening. They're not going to happen. If anything, they're going in the opposite direction, as we just saw a couple weeks ago. So ultimately, the Fed raising rates drives higher deficits, higher stimmy on a lag, all of which is stimulative, while at the same time curtailing on some level the private sector's ability or willingness to increase capacity to address that. So we have a constriction of private sector ability to address and an increase in government-led stimmy demand. That's what happened in COVID. And we know how that ended up. It was inflationary. It was stagflationary. It was good for nominal growth. It wasn't necessarily great for real growth. So here we are once again. And look, it is what it is. It's really the only palatable option. And so I think investors just have to understand that's the operating environment in which we are in, and adjust accordingly in terms of their investing allocations.
So you paint an interesting dichotomy there. And, ultimately we have this weakening economy versus this rising inflation. It's really the worst possible outcome for the Fed. What does the Fed do when inflation is rising, economy is weakening? If they cut rates, inflation is likely to skyrocket. If they raise rates, the economy can crash. This is not exactly the definition of a soft landing, is it? I mean, what does the Fed do here?
I think the Fed has repeatedly since 2020 committed to maintaining Treasury market functioning. Repeatedly. Powell has said it in 2020. We saw it in 2022. We saw it in 1Q23. We saw it in 3Q23. We saw it again, like I said, late last year. We saw it even in before COVID in 3Q19. The repo rate spike. There were some regulatory issues, but that was ultimately a short and blow up in rates. And the Fed came in within 48 hours and stopped shrinking their balance sheet, began growing it. So we have 5 instances in the past 4.5 years where the Fed has told us by their actions, we will not allow Treasury market dysfunction, full stop. And so to my eyes, that is Fed mandate number one. And most of the analysis I still read assumes, number one, that mandate doesn't even exist. That's like the black sheep, that's the crazy uncle we keep in the closet and we don't let him out, in the basement, except for holidays. Everyone wants to talk about full employment and what's GDP doing. And at the end of the day, actually what matters is Treasury market functioning. So as long as the Treasury market's functioning okay, which if there's enough dollar liquidity, it will, then sort of everything else feeds off of that. And so to me, I think nominal growth is going to be fine. I think it's going to continue to run 5 to 6%. I think anyone who owns a 10-year Treasury at 4.75% is essentially the sucker at the card table. I don't know why you would own a 10-year Treasury at 4.7 when the United States government just gave the DoD personnel a 5.2% pay increase. And you know what? I'm not complaining they got it. I love that they're getting it with it. It's what we need to do when we talk about fixing wealth inequality, income inequality. The middle and working class has got to get paid a lot more. We got to have a wage spiral for those people, like we had a wage spiral for Wall Street and for the 1% over the last 30, 40 years. But that is terrible for 10-year bonds at 4.7%. There's no reason to own them. There's certificates of confiscation. So what do I think the Fed's going to do? I think they're going to make 10-year bonds. I think they're going to make treasuries certificates of confiscation on a real basis. I think nominal GDP will run 5, 6, 7, 8%. I think real will run whatever it runs. I think they'll tell us inflation is whatever it is. I think half the country will believe it no matter what they tell them it is, and the other half won't. So they might as well try to get away with it. And I think we'll continue to see what we're seeing, which is really good for gold relative to TLT, really good for Bitcoin relative to long-term bonds, really good for stocks relative to long-term bonds, really good for industrials relative to long-term bonds. And I think we're going to have this very persistent, secularly inflationary environment for a time. At some point, the bond market wakes up and goes, oh gosh, I'm the sucker at the card table. Then things get a little more interesting. And when that happens, everyone is, I put this in a number of my reports. People are very fond of saying, well, we're just going to be Japan. Yeah, well, we have this chart. It shows the Bank of Japan's balance sheet relative to GDP, Japanese GDP, against the Fed's balance sheet relative to US GDP, except just lagged 10 years. And what it tells us is sometime in the next 5, 6 years, the Fed's balance sheet is going to go to 130% of US GDP. 40 trillion, give or take. That's what's going to happen. And like, if that's not how we wanted it to end, if we didn't want it to end that way, we shouldn't have sort of done a lot of the things we did for the last 25, 30 years.
So as far as the assets you mentioned, it sounds to me like the trend is your friend at this current time. It was just a few months ago that the market was pricing in 7, 8 rate cuts this year, right? Now none are priced in before December. So I'm curious, do they now have the perfect setup for an emergency rate cut, which would send stocks to highs before some economic implosion? Like, what do you see there?
I don't see how we can have an economic implosion with deficits running at 7% of GDP, and they're going to go higher unless inflation stays high, just because of what we've done with interest rates. So, I mean, can they cut? Sure, they might be able to cut. I just don't know that it matters that much.
Okay.
Whether they cut, whether they hike, like, because the key is if they hike, okay, yeah, that you could get some sort of like little bit of bumpiness in the markets like we had a couple weeks ago. But again, then when we have, when stocks start to really fall, if stocks were to really fall, then you need the Fed to stand aside. Let a treasury auction fail. Let a bank fail and let a depositor with more than $250,000 in the bank lose their money. Like this bank just failed in Philadelphia on Friday, right? The very bottom of the press release, the Deposit Insurance Fund took a $670 million hit. FDIC Deposit Insurance Fund. Translation: the Fed printed the money to make depositors whole. If the Fed wanted to stop inflation, they needed to let that bank fail, sell it and merge it into the other bank, wipe out the equity, and let everybody, that 670 million, go poof. And that's now the third, fourth. They didn't let any of those bank failures we had last year. They let none of the depositors go poof. They're not going to let any of the deposits go poof. So now when you go, okay, let's pretend commercial real estate gets a lot worse. Let's imagine we have this reset and low prices don't recover. And let's say we have a massive regional bank failures. The Fed is going to print every dollar and backstop every deposit that's in there. That's not deflationary. If they wanted deflation, if they wanted inflation to stop, they would say, you had 400,000 in that bank, the limit's 250. Thank you for your donation for the 150,000. Or you had 5 million in the bank, 250. Thank you for your donation to $4.75 million. It's gone. And of course, that would touch off a bank run, and then we'll get deflation. But other than that, like, the Fed keeps telling everybody, this inflation is not transitory. It's secular, and it's going to get worse.
So there were, I believe, when we had those bank failures, we did see the market drop for a period of time until they came in with their rescue, so to speak. So is that what you see happening again?
I could see. I mean, I could see at any point in time, yes, but from a secular standpoint,
yeah,
the stock market, they have allowed the system to evolve such that the stock market backs the treasury market. We know, and we've seen that it's been proven 3 times empirically in the last 4 years. So I first wrote this probably 3-4 years ago. I wrote it, but 10 years ago, that the stock market had become the key marginal driver to tax receipts via consumption. And I was laughed at the time in some quarters. But this was IRS data. I wasn't guessing. Like, I knew this.
Especially with the boomers where they are right now.
So we've now seen 2020, 2021, we have an everything bubble, right? So we have a $3.1 trillion deficit with COVID, whatever it was in 2020, 21. So we go from 3.1 trillion in 2021 down to 1.4 in 2022, or 1.2, right? We looked at 1.7, 1.9 trillion. Well, what happened? Well, tax receipts boomed because the price of everything went up a ton. We had an everything bubble. Receipts boomed. We can see it in the numbers. Fast forward, Fed starts hiking in 2022, stocks fall, bonds fall, etc. The deficit, surprisingly, nearly doubles in fiscal 2023. Washington Post, New York Times, Wall Street Journal, all these economists say, wow, what happened? We've never seen the deficit double at a time of nearly full employment. This makes no sense. Yeah, it does. The key marginal driver to the U.S. economy are stocks going up, full stop, through the tax receipt, through consumption. So that's the second time we saw it. So we saw the deficit go from 3.1 to 1.2 or 1.4 on an everything bubble. Then we saw the deficit go from 1.2 or 1.4 to 2.1 on Fed tightening. And we just saw it again 2 weeks ago when Yellen came out and said, hey, receipts were best number since, wait for it, April 2022, because everything was up last year. So there's this dynamic of like, well, can stocks fall? In theory, yes, but not for long, because ultimately stocks falling are going to create treasury dysfunction. Then we go back to rule number one. Rule number one is treasury market dysfunction will not be allowed. Paradoxically, the stock market backs the treasury market by virtue of the receipts. So if stock market goes down, receipts decline a lot. And when receipts decline a lot, issuance goes up a lot, the dollar goes up, and you go into a debt spiral like we saw in third quarter last year. So and that won't be allowed. So it's one of these things where it's like stocks over, S&P over TLT has been like one of the master charts for me. And it's just like, and not only is it going up, it's starting to go up asymptotically. And I think that's going to continue.
Yeah.
You'll get pullbacks, but
it makes a lot of sense. So they have to inflate in order to keep tax receipts high, in order to ultimately prevent a treasury market, knockdown.
Yeah, I mean, a lot of people looking for crashes. We got our crash last year in the third quarter. TLT, the long-term treasury bond, it crashed 20% in the third quarter last year. Like that's a crash in any asset, but in that asset, the most important, the deepest, most liquid, wow, and capital was supposed to be flowing into that asset. The dollar was going up. They were supposed to be flocking into that for safety. It crashed 20%.
So modern monetary theory is the predominant belief system in DC today. The historic debt and deficits are supportive of that. You astutely pointed out MMT requires one, a robust domestic industrial base, to respond to inflation. Number two, low sovereign debt, so rate hikes to fight inflation don't exacerbate it. Three, functioning domestic politics to quickly hike taxes to fight inflation. In 2000, U.S. was 3 for 3. Today, 0 for 3. In your analysis, what ultimately stops the runaway debt and deficit train that we have today? And if nothing, what does that world look like for the average investor coming up?
Inflation stops it. I mean, when we do not have a functioning industrial base like we did in 2000 or its globalized equivalent, particularly when we're picking a fight with the biggest trading partner vis-a-vis China. So that's right, because the MMT it's really an accounting description, and it's in a vacuum, it's correct. It's how it describes the system as it's worked. But the issue now is we don't have a functioning industrial base because we've offshored too much and then picked a fight with China, and China may not have our best interests at heart, so on and so forth. So there's frictions there. Frictions are inflationary. So that tells you secular inflation should be higher, all else equal. Strike one. Low debt. You can raise rates really fast when you're running fiscal surpluses like we were in the late 90s and very early 2000s. And our debt to GDP was 50, 60%. You're not going to blow up the government before you blow up the private sector somewhere in the world. That's no longer true at 120%. We've repeatedly seen it. Those 5 episodes of treasury dysfunction since fall of 19 were essentially monetary tightening, blowing up the U.S. government before they blew up the private sector. And so that is also a problem. And then number 3 is functioning politics. These parties are two birds of the, two wings of the same bird.
Yeah.
It's all war all the time. No political courage to do anything vis-a-vis entitlements at all. And the Fed's hiking rates on them. And the only thing they spend money on that matters are interest. Okay, so that's going up. Entitlements, those are going up. and defense, and that's going up. So here we are. What does it mean? What it means is essentially MMT, it's all pro-cyclical. It's all gas, no brake, right? And not only is there no brake, but it's like somebody like broke the throttle off in the full-on position and then locked it in place. Like, so the only thing that's going to stop this are very high levels of inflation. Like they're not going to get religion at 5, 6, 8, 10. Like at some point, inflation's going to go to a level where it really scares them. But I don't think we're anywhere near that yet.
Well, that's interesting. That was my next question. So inflation in the 70s had three very distinct rises and peaks. And in 22, as you mentioned earlier, U.S. inflation peaked, subsided in 23, but it never did return to the Fed's 2% red line. Now, at the end of 2023, beginning of 2024, inflation's clearly on the move again. It's rising. Luke, do you see similar patterns emerging as was happening in the 1970s? And based on what you just said, it sounds like it. But how high do you fully expect inflation to go here moving forward?
As long as the Treasury market functioning is mandate number one, and it is, and it will continue to be, in my opinion, then higher on inflation. How much higher? I did an analysis in April 2021 for clients that looked at the last time U.S. debt to GDP was as high as it is now, as an analog to try to see, okay, the only way out of this is productivity miracle or you inflate the debt away.
Was that the 40s, the 1940s?
Yeah, the 40s, exactly, right? So 46 debt to GDP is 110%. By 51, it's 55%. And so the Fed was in yield curve control. They capped the long end, they capped the short end. Inflation, real rates, I think, bottomed in the United States at negative 13%. So basically, inflation was 13 points above the interest rate on your bond. Your bonds were certificates of confiscation. Nobody minded because we won the war, rah, rah. And okay, great. It was seen as a patriotic duty, rightfully so. So I said, let's use that as our analog. We're at 120% debt to GDP. And this was the analysis in April 21. Let's say we bring it down over 5 years, like we did then, 46 to 51 over 5 years. Let's say we need to get it back to 70 to 80% debt to GDP, because that, in my opinion, in my view of in my analysis, was where debt to GDP was last when the Fed could hike and be independent without blowing up the Treasury market, without creating Treasury market dysfunction. And then finally, noting that since 2008, U.S. debt had grown by 8% per year compounded annually. So 8% CAGR debt growth. So we said, okay, 5 years, 120%, 8% CAGR debt growth. We need to get it to 70, let's say 75%. What is the implied negative real interest rate, right, to get to that, to solve for that equation? And what I got then was 12 to 18% negative real interest rates for 3 to 5 years. In other words, inflation above rate. And of course, like back then we had capital controls. Gold was illegal to own. So you couldn't do that without capital controls in the United States, without yield curve control. Like the bond market would revolt. So that gives you some sense of, you're going to need at least 15% inflation for at least 3 to 4 years. And every day they delay puts a little bit more upward pressure on either the rate of inflation or the duration of the inflation. In other words, you need higher for longer inflation.
So on that whole summary framework there, why would investors continue to invest into the articles of confiscation under that scenario, which ultimately, if they don't, creates dysfunction in the Treasury market? And then secondly, if you have 15% inflation for 3 to 5 years, how does the bottom half of society successfully live?
So question number one, they believe it for the same reason they believe that home prices could only go up, that home prices could never fall nationally, that piece of crap mortgage-backed securities that were AAA rated couldn't default because no AAA rated security had ever defaulted, not grasping until it was too late that they were AAA rated because they were fraud. For the same reason they were buying sock puppets in 2000, pets.com, and thinking like it's the same thing, except it's in the most fundamental collateral underpinning everything. That's reason number one. I'm not as negative on the prospects for the bottom 50%. I mean, over the last 25 years, the bottom 50% the net worth has barely risen, whereas the top, last 35 years, the bottom 50%'s net worth has barely risen, while the net worth of the top 1% has risen like 9x or something. So what we're really talking about here is a wage spiral for the bottom 50%. And it's terrible for bonds. It's terrible for bondholders. It's great for the government. They need inflation, number one. And people always say, I'd never bet against America. It's funny to listen to. I'll never bet against America. Okay, well, America needs negative real rates of 15%. Oh, that's communism. Are you not going to bet against America, or are you going to bet against America? Because you can only.
Well, you're just talking math here.
Exactly.
Math versus politics here.
Yeah, don't get against America. Okay, well, America needs negative 15% real rates. Now explain to me like I'm a 2-year-old why you still own that 10-year at 4.7. Okay. So the government needs negative real rates. They need this inflation. You need a wage spiral we have a gross misallocation of resources, and we're seeing this everywhere. Whether it's in the Ukrainian war, where we're getting outproduced by a quote unquote gas station masquerading as a country because our industrial base is sitting in China, in no small part. We need people Charlie Munger, show me an incentive, I'll show you an outcome. For 40 years, we have allocated our resources so that bondholders, bond exporters, bond traders, paper asset creators do really well, and the bottom 50 don't. And this, you start having some serious wage inflation, that'll fix this. And that's what I said. Not only does it delever America, it de-escalates what is increasingly dangerous political destabilization in this country. It's not good when the top 1% have 45 trillion in wealth and the bottom 50 have, I think it's 5 or 6 trillion. Like it doesn't, or 3 trillions, whatever. Like that's not a good outcome. That doesn't end happy. And people want to, the inflation is going to save bondholders from themselves in this case.
So folks have a wide-ranging viewpoint on this, and it's pretty bifurcated. But with robotics and AI coming on pretty strong, and I know that they're several years away from really making a dramatic impact. But just trying to think out into the future, why wouldn't a business who's facing wage price spiral and other extremely hot inflation across the board and everything that they're dealing with, plus presumably higher taxes as we move along, as we've been hearing rumblings of that too, why wouldn't they choose artificial intelligence automation for multiple areas of their business if it's available? Why wouldn't they choose robotics if it's available, instead of an employee who's unpredictable, who can call in sick, who requires healthcare and their retirement package and raises periodically here? Why won't those things? Why wouldn't they do, like we've seen it in California as the fast food restaurants are going to $20 an hour minimum. Now we're starting to see automated kiosks and other automation come in, and it's eliminating jobs. Why won't we see that, or will we?
Oh, we might. And the follow-on is we also just saw a near bond auction failure in California last month, right? They went to go sell bonds and they almost couldn't. Like the tail on it was enormous. So that goes back to my point of okay, and rolled out across. What happens to government tax receipts when that happens? They plummet. What happens to political stability when that happens? It plummets.
Yeah.
And so I go right back, yes, it could drive productivity. And if it drives productivity too slow, we get a bond market problem. And if it drives productivity too fast, it takes too many jobs, we have a bond market problem. So for me, personally, and in terms of what we've been writing about, I try to invest in a way where I'm sort of agnostic to that outcome from a political standpoint and just say, look, like unless AI shows up exactly perfect in terms of timing, you're going to have a bond market problem either way. I don't want to be there. And then go back to rule number one. Bond market problems will not be allowed. They will print the money.
Yeah. Wow. Okay. Yeah. And I see exactly what you're saying. So this next question, you've touched on this several times, Luke, with different folks. In 2008, GDP dropped 3 points. There was record bailout, stimulus, Fed actions taken. If they suddenly moved to austerity and pulled out like 5 points of GDP to lower the debt and stabilize everything, wouldn't that drive the economy into calamity? So what happens to the markets once it realizes that austerity is really not an option here?
It's not. It's not an option. And I think once that happens, it really is. Like, to me, people keep looking for the next, what's the next 08? What's the next subprime crisis? What's the next grossly mispriced security or sector? And to me, it's easy. It's Western sovereign debt. It's the treasury market. What happens when people realize that austerity is not coming? I think it has started to recognize it, but consensus is nowhere near there yet. And what I say that the market's starting to recognize is, call up the chart, GLD divided by TLT, boom. S&P over TLT, boom. S&P industrials over TLT, boom. NASDAQ over TLT. This is an important one, right? Not just gold. So gold and real rates are supposed to trade together. They should never go boom unless the market's starting to say that paper is crap on a real basis. That's when boom means the market is making a decision. When gold over TLT does that, that's the market saying that paper's bad on a real basis. S&P, you can make case, okay, NASDAQ's also, a long duration trade, right? For a while, NASDAQ and rates were like, rates up, NASDAQ down, rates down, NASDAQ. All of a sudden, boom, last year, right? The NASDAQ was up and rates were up a ton. And so in my view, what that is the markets quietly saying, I'm out. Bitcoin over TLT. That paper is bad on a real basis. That paper cannot be, it's a certificate of confiscation. And of course, the reality is that the bond market globally, $130 trillion. US equities are 60, 70 trillion. The gold market's 14 trillion, even with this jump up. Bitcoin's 1.3 trillion.
Yeah.
It's tiny. So what you're going to have $130 trillion is already starting to cram into a grand total of, 60 plus 13 plus 74 trillion. And again, on the upside, go back to rule number one, bond market dysfunction will not be allowed. So 130 trillion will cram into these other assets. And as soon as, and in the meantime, by the way, government deficits are still adding to the amount of debt, corporate issuance, blah, blah, blah. You'll get dysfunction. And as soon as you get dysfunction, Fed says, nope, more liquidity, and then it squeezes back into these things. So I think we're in the very early days of a recognition by markets, basically a crowding out of Western sovereign debt into assets that will better protect purchasing power, as what's increasingly becoming inevitable happens.
I think to your point that we're nowhere near widespread recognitions. The 60-40 portfolio is still by far mainstream.
Oh my gosh.
So,
yeah,
right?
I was at a speech not that long ago where somebody said, I hear you on gold and Bitcoin, Luke, but if gold goes down 30%, I get fired. And if long bonds go down 30%, I keep my job. And I'm like, I know. And I didn't say it, but I thought to myself, and by the end of this cycle, that'll be reversed. you will lose your job if you will lose you lose your job if you don't own gold, and if you
Yeah.
own long bonds, and then maybe it'll be time to look at long bonds.
Yeah. So, Luke, the U.S. used to go to war and spend trillions to prevent foreign leaders from moving away from the U.S. dollar and into gold for their transactions with other countries, especially when they were selling oil, right? They took out Saddam and Gaddafi because of that. Now they seem to have done a complete 180. They're okay with foreign leaders moving to gold and away from the dollar because when they do that, they won't have to sell their treasuries to raise the dollars to buy the oil or to settle the transaction differences. So instead of interfering, they seem to be preferring to let them trade in their own currencies and settle in gold. Will you speak into the implications of this as to the impacts on the dollar, the treasury market, and anything else of significance?